If you're watching this, chances are you're thinking about buying a home, investing in real estate, or figuring out how to use the equity you already have. 2026 is shaping up to be a very different mortgage year. Rates are stabilizing, lenders are changing how loans are delivered, and borrowers have more flexible options than we have seen in years. I'm Jason from Truss Financial Group, and today we're breaking down the mortgage trends that actually matter in 2026, whether you're a home buyer, homeowner, or real estate investor. Grab a coffee and let's get into it. 1. Stable rates. Bring creative financing strategies. After years of volatility, mortgage rates in 2026 are expected to stay relatively stable, hovering in the low 6% range. That does not mean cheap money is back, but it does mean predictability is back. When rates stop swinging every week, buyers can plan again. We are already seeing more confidence in the market and a gradual pickup in transactions. That said, affordability is still tight, which is why creative financing is making a big comeback. Buyers are using seller concessions, temporary buy-downs, adjustable rate mortgages, and even assumable FHA or VA loans where possible. Investors are also adapting. Interest-only periods, shorter-term financing, and refinance strategies are being used to make deals pencil in a higher rate environment. The key takeaway is simple. Rates may not be exciting, but stability is pushing borrowers to think strategically instead of emotionally. 2. Homeowners tap into equity instead of moving home. Equity is taking center stage. After years of rising home values, Americans now hold record levels of equity, totaling trillions of dollars. At the same time, many homeowners feel locked in to the ultra-low mortgage rates they secured in 2020 to 2021. If you had a 3% rate, would you want to sell or refinance into a 6+% loan? Probably not. Millions of homeowners locked in rates between 2 and 4% during the pandemic, creating what's known as the rate lock-in effect. This has kept housing inventory tight and pushed homeowners to look for other ways to access cash. Instead of moving or refinancing their first mortgage, many are turning to home equity loans. In 2025, HELOC balances steadily increased, and that momentum is expected to continue into 2026. These options allow borrowers to access funds without touching their original low-rate mortgage. Home equity is being used for renovations, debt consolidation, and even investment property down payments. Swapping high-interest credit card debt for a lower-rate home equity option is especially popular. While borrowing against your home comes with responsibility, many homeowners find the trade-off worthwhile. With so much equity available, 2026 is shaping up to be all about using it wisely, making home equity one of today's most valuable financial tools. 3. The rise of digital HELOCs. Tapping into home equity is getting easier thanks to technology. One trend gaining serious momentum is the rise of digital HELOCs. A digital HELOC allows homeowners to apply for and secure a home equity line of credit through a fully online, streamlined process, eliminating weeks of paperwork and in-person bank visits. Fintech lenders and forward-thinking banks are rolling out faster, more user-friendly HELOC platforms, and it's reshaping how homeowners access equity. Today's borrowers expect digital convenience, from quick approvals to online portals, and the mortgage industry is responding with data-driven underwriting and digital-first applications. Even major lenders are jumping in. Why? Because home equity lending is booming. Many homeowners are locked into low mortgage rates but still need cash for renovations, debt consolidation, or other expenses. Digital HELOCs provide a convenient solution. Imagine applying from your phone or laptop, receiving approval in minutes, and accessing funds in days, not weeks. In some cases, homeowners can start using their equity in as little as 10 days, a major improvement over traditional HELOC timelines. Truss Financial Group already offers a digital HELOC solution designed to be fast, simple, and flexible. It's a trend we're excited about because it means less hassle, quicker access to funds, and more control over your home equity. 4. Hybrid STR loans and DSCR loans. Power investors. Hybrid STR loans are one of 2026's big game changers in real estate financing. These mortgages blend the best of two worlds, the traditional income-based loan and the rental cash flow loan, into a single package. In plain English, a hybrid STR loan lets you count both your personal income and your short-term rental, Airbnb-style income when qualifying. This is a huge deal for people who live and rent. like owner-occupants renting out a spare unit, or investors with side gig rentals, because previously lenders would only consider one income stream or the other. Now you can leverage that W-2 salary and your Airbnb revenue together, making it easier to get approved even if one by itself wouldn't cut it. Why does this matter in 2026? The short-term rental market has matured, and lenders finally have the data and tools to safely include rental income in loan underwriting. Truss Financial Group is among the first U.S. lenders to offer this hybrid STR mortgage program, designed specifically for today's Airbnb and vacation rental investors. In short, hybrid STR loans are empowering a new class of homeowner investors by recognizing both their personal earning power and their property's income potential. A win-win for 2026's savvy homebuyers. 5. Home renovation loans on the rise. Don't move, improve. That's the motto for many homeowners in 2026, and it's fueling a surge in renovation loans. With higher mortgage rates and rising home prices making it harder to move, many homeowners are choosing to stay put and upgrade instead. Surveys show nearly half of homeowners now plan to renovate rather than relocate. So what financing options can help turn an outdated home into a dream space? Here are 3 renovation loan options gaining traction. Home equity line of credit, HELOC. A HELOC lets you tap into your home's equity as a flexible credit line. You borrow only what you need when you need it, similar to a credit card backed by your home. This option works well for ongoing projects or multiple smaller upgrades spread over time. FHA 203K loan. This government-backed loan combines renovation costs into your mortgage. It allows you to buy or refinance a home and renovate it in one loan, even if the property doesn't qualify for standard financing. With low down payment requirements, it's a popular choice for primary residences that need repairs. Fannie Mae Homestyle Loan, a conventional renovation loan offering more flexibility than FHA options. It can be used for primary homes, second homes, or investment properties and allows a wider range of upgrades, including luxury improvements. 6. Mortgage trends for self-employed borrowers in 2026. By 2026, self-employed borrowers will have more mortgage flexibility than ever before. Loan programs that were once considered niche will become standard options, giving entrepreneurs, freelancers, and gig workers real paths to home ownership and real estate investing. Traditional tax return only underwriting will no longer be the gatekeeper it once was. Lenders will increasingly rely on bank statement loans and P&L only mortgages, allowing borrowers to qualify using business deposits or profit and loss statements instead of adjusted taxable income. For real estate investors, DSCR loans will continue to grow in popularity, with approvals based primarily on rental property cash flow rather than personal income. Asset-based mortgages will also gain wider acceptance, enabling high net worth borrowers to qualify by leveraging liquid assets or investment portfolios in place of traditional income documentation. Technology will play a major role in this shift. AI-driven verification tools will streamline income analysis by reviewing bank transactions, P&L reports, and alternative documents quickly and accurately. Secure digital portals will pull financial data directly, reducing paperwork and speeding up underwriting decisions. As a result, being self-employed will no longer be a disadvantage. In 2026, mortgage options will be designed to match how modern business owners actually earn, spend, and invest. 7. No appraisal. HELOCs gain momentum. By 2026, no appraisal HELOCs will become a popular way for homeowners to access equity faster and with less friction. Instead of requiring an in-person appraisal, lenders will increasingly rely on automated valuation models, AVMs, to estimate a home's value using real-time sales data and market trends. These digital valuations will deliver results in minutes, not weeks, removing one of the biggest delays in traditional home equity lending. As lenders continue to adopt AVM technology, the process will move almost entirely online. Application to funding timelines will shrink dramatically, allowing homeowners to access cash far more quickly than in the past. In many cases, appraisal fees will be reduced or eliminated altogether, lowering upfront costs and simplifying the borrowing experience. For homeowners, this shift will be especially important in a higher rate environment. No appraisal HELOCs will allow borrowers to tap into their home equity without refinancing their existing first mortgage. This means homeowners will be able to keep the ultra-low interest rates they secured in previous years while still unlocking funds for renovations, debt consolidation, or unexpected expenses. By 2026, no appraisal HELOCs will no longer feel like an exception. They will be a mainstream, tech driven solution built for speed, flexibility, and today's equity rich homeowners. So there you have it, 7 mortgage trends to watch in 2026. It's an exciting time in real estate finance. The market's always changing, but that's why we're here on this channel, to keep you informed and help you navigate it. Which mortgage trend excites you the most? Let us know in the comments. If you have questions about how you can take advantage of these trends, maybe you want to explore a HELOC or get pre-approved for a home purchase or figure out an investment loan, reach out to Truss Financial Group. Our team is here to help you every step of the way, whether you're buying your first home or your 5th rental property. We pride ourselves on staying on top of mortgage world developments, and we'd be thrilled to help you craft the right strategy for your situation. Lastly, if you found this video helpful, don't forget to hit the subscribe button and ring the notification bell so you never miss an update. We've got more great content on the way, and you'll be the first to know when we drop the next insider look at real estate and mortgages. Thanks for watching, and see you next time. Happy house hunting and investing.